Nilesh Shah joining us as well this morning. Nilesh, great to have you with us this Monday. And let me kickstart with the interview that the Economic Times has done with the Finance Minister, where she has said for the first time that she's willing to listen to concerns with regards to the FPI surcharge, and the intent was not, of course, to single out FPIs in particular. And she's continued to hold her stance with regards to the fiscal deficit, Nilesh, and I know that's something which you along with many market participants have been saying perhaps the government should be a little softer on in an attempt to push growth. What do you make of the comments coming in from the Finance Minister and the state of things as they currently are?
I think it's a welcome step when Finance Minister says that she'll be open to the demands of the FPIs and she'll hear them out. My only submission will be that please have level playing field between FPIs and domestic investors. Both bring money to the capital market and both deserve similar set of tax treatment. Clearly, from an economy point of view, today we are going through a transition period where some portion of economy, in terms of inflation, in terms of fiscal discipline, in terms of NPAs, is on a far better footing than it was in the past. However, there is a price to be paid for controlling inflation by pursuing tight monetary policy and high real interest rates, which we are seeing in terms of growth. Now, it is up to the government and the regulator and the entrepreneurs to ensure that the foundation which is laid on the back of lower inflation, better fiscal discipline, a tight monetary policy, a better disclosed and controlled NPAs is converted into higher growth. Ultimately, growth is the solution, because higher growth will result into higher tax revenues, controlling fiscal deficit. Higher growth will create more supplies, in turn ensuring that inflation remains low.
Yeah, and that is something that we've been grappling with for a while, Nilesh, how to kick in that growth. Although the Finance Minister says that, she wishes that there is a rate cut next policy in August and a significant rate cut to that extent. And she's saying that that would do a lot of good to the country and that would definitely bring demand revival in. Would you think it's imperative that there is a sizable cut from the RBI this time around?
So rate cut alone is not the trigger for revival of growth. It will require a series of steps. We have seen RBI keeping banking liquidity in surplus since May 2019. The banking liquidity is now 1 lakh crore plus. That should continue for a foreseeable future. Second, real interest rates were high. RBI has already brought it down by 75 basis points. That should continue till such time we have a real interest rate burden comparable to our peers on our entrepreneurs. The third thing is related to transmission of credit. The PCA banks, PCA which was imposed on PSU banks, that along with NBFCs have moved out of the credit market. We have to defreeze credit market so that certain segments of economy like small and medium enterprises, constructions, real estate, infrastructure starts receiving flow of credit. We also need to be lucky on oil. Despite US-Iran skirmishes in the Gulf, the oil prices have remained remarkably steady. That should continue. June monsoons were deficient. July monsoon has been progressing well. That should continue in August so that the rural and agriculture economy gets a boost. Apart from this, there is one more important thing, which is policy predictability. Clearly, entrepreneurs will invest money not only because they have liquidity, interest rates and availability of credit, but they will also want stability of policies. If there is policy predictability, then entrepreneurs will come back to investment. And clearly today we have seen that Indian economy was firing on government expenditure and consumption, but private investment was on the back foot. Now consumption has slowed down a little bit. Government expenditure by virtue of fiscal discipline is not going into front gear to compensate for the private investments which is on the back foot. So it's important that through policy predictability, we encourage entrepreneurs to start making investment.
Nilesh, just wanted to get in your take as to what's going on with the bonds. You know, we have seen that the uncertainties over the sale of the sovereign bonds overseas, that is causing yields to harden unexpectedly back home. What is the outlook, and do you believe that, you know, this combined with the fact that we have seen fewer rate cuts, that is pushing the yields up, and bond investors perhaps are going to look at recalibrating positions?
After a rally of almost 100 basis points, it is natural for yields to pull back. Discussion on sovereign bonds could be one trigger, otherwise some other trigger would have come. Clearly today globally interest rates are coming down. There are more than $13 trillion worth of bonds which are in negative territory. A country like Switzerland, all the way up to 50 years is borrowing on the negative interest rates. So clearly there is room for Indian interest rates to come down. It is coming on the back of fiscal discipline enforced by government. It is coming on the back of RBI anchoring inflation and inflationary expectation through appropriate monetary policy. And now it is time to, reap benefit of those two discipline. Our targeted inflation rate is about 4%. And since introduction of that target, inflation has more or less remained below that. You add 0.5% spread for repo, another 0.5 to 75 basis point for 10-year yield. Effectively, it shows the roadmap of how 10-year yield can decline over a period of time if fiscal and monetary policy continues to remain controlling inflation and inflationary expectations.
You touched upon, consumer demand, Nilesh, and I want to get your perspective on consumer financing companies. We haven't necessarily seen a detrimental impact, but we have seen a slight dent. We've started to see the impact nonetheless on consumer financing, in this quarter's earnings. Do you see this as a trend that will continue? We've also seen, NBFCs as well, in order to try and stay afloat, cut down a little bit, on those growth and on lending. So, do you see this as a continued trend now going forward, unless we do see some stimulus coming in the form of that rate cut?
As of today, there are two forces at play. One on a top-down basis where most NBFCs are cutting down on growth because refinancing is becoming difficult. It's difficult for them to raise capital, be it debt or equity, from the capital market, which is reflected into their balance sheet. However, here there will be two differentiators. There are companies which are more exposed to real estate sector, and they will find it a bit difficult to get refinancing. However, there are many companies which are exposed to automobile financing, personal loans, gold financing. As long as they have governance in place and liability franchise which is well diversified, they will continue to show reasonable growth. Obviously not at the higher end of the expectations of the market, but they will be somewhere meeting expectations of the market. It is the real estate exposed sectors, it is the real estate exposed NBFCs where there could be disappointment. On the other side, we are also seeing slowdown in consumer demand reflected in negative sales for automobiles and some of the consumer durables. This is a broader theme, and NBFCs who have money will also find it difficult to get customer whom they can lend it at reasonable rate. So that cycle will take some more time to revive, and put together we will see NBFC sector continue to underperform the market. But in that underperformance, over a period of time, you will get opportunity to buy quality businesses where liability franchise is well developed, where governance issues are beyond doubt.
Talking about autos, how prolonged is this slowdown going to be in the auto space, Nilesh? Because you've got the government now slashing the GST rate on EVs to 5%, but on the same hand, new registrations, there's been a big spike coming in. I mean, how long is this slowdown going to last? Because EVs, again, is a long gestation a phenomenon, that's going to take some time to be a reality. Of course, there are other debates on whether the infrastructure is ready for it or not. But at the same time, this spike coming in new registrations is definitely going to keep new buyers at bay.
The only silver lining among the dark clouds in automobile sector is launch of new product. We have seen one product advertised recently by a Chinese company. They collected so much of bookings that they had to shut the bookings. There was another launch by one more company trying to enter India, and they also collected fair amount of money. So clearly, if there is excitement around a new product launch, if there is aggressive pricing, it shows that there is demand. However, auto sector has not been able to launch as many new products as needed to create this excitement and keep up this excitement because of variety of regulations. One, there was transition to BS6. Anyone buying a diesel car today will knows that post 1st April 2020, the prices will drop dramatically. So people are postponing their purchase. The secondary market in used car has gone up by 13-14%. So it's not that people have stopped buying cars, it's just that people are moving to second-hand cars because of regulations like BS6 transition. The second thing is increased cost, whereby insurance is being paying for 3 years. The third thing is also related to this electric vehicle policy. That is also restraining current automobile manufacturers to continue making investment in new products, as the recovery rate on product cycle is about 10 years plus. Put all these things together, we have entered into a phase where automobile manufacturers are not willing to launch new products unless until they are entering a market like India. And that lack of new launch of product, along with higher cost and uncertainty on policies, is kind of subduing or pushing consumer demand. We have to wait for stability to come in terms of policy predictability for automobiles manufacturers to launch newer products. We have to ensure that consumer finance is available so that people can buy these automobiles on loans, and combination of that may create a bottom for automobile sales.
Okay. Where do you stand, Nilesh, when it comes to the overall fund flow situation? You know, compared to the rest of the emerging markets, we've seen a massive outflow for the Indian markets. Is this going to continue? What with the economic slowdown that you've been talking about, as well as the FPI concerns? Are we going to see a further FII exodus, and is that going to weigh down on the markets?
If I look at FPIs exodus, that is probably more a reaction to the surcharge levied in the budget. Yes, we have seen a slowdown in our growth, but compared to the slowdown in the global market, we are still one of the fastest growing economy. So this is more of a sentimental exit rather than fundamental exit. My feeling is that FPI's flows can be reversed if we can ensure that their sentiments are taken care of. There are some good proposals in the budget related to increase in FII limit to sectoral limit in PSU stocks. If that happens, our weightages in MSCI emerging market index goes up, and to that extent we will see some increased flows over a period of time as and when that becomes effective. So FPI's outflow is more on a sentimental account because of increased taxation or reaction to increased taxation. If that can be managed, I'm sure those outflows can be reversed.
Fair enough. Let's talk about the banks, Nilesh. And you've talked about, how you're closely looking at the PSB recapitalization. So the private names, the corporate names aside, because everyone knows that, we're anticipating them to be beneficiaries of the growth story. On the public sector side as well, what's the kind of boost you see post recapitalization? Would there be specific names you'd be looking at? What's the rationale there? Do you feel that the asset quality concerns post what we've seen this quarter are starting to now look like they're stabilizing?
So on the corporate side, definitely there is a stabilization as well as downward trend in the NPAs, as over last 3-4 years, a lot of NPAs have been provided for. However, the concern is now emerging on the SME loans and personal loan portfolios, and commentary by various banks and NBFCs which have announced the results so far are indicating a caution towards that. The second thing for PSU Bank is also in relation to their governance. Clearly, they face a lot of administrative constraints in terms of executing their business. For example, there is compulsory 3-year rotation policy. Now, we have seen so many private sector banks making money on wealth management and advisory practices. Now, if you put 3-year rotation policy in such specialized service, it does not necessarily help you to run that business more efficiently. So apart from capital, what needs to be taken care is the administrative aspect of PSUs. They have some incredible talent available in those banks, but they need to be encouraged, they need to be freed in terms of doing their business. The third thing will be related to compensation policies. The average pay of a public sector bank employee is higher than average pay of a private sector bank employee. However, at the bottom, private sector banks pays less compared to public sector banks to their employees, but at the top, a private sector bank pays far more than what public sector bank is paying. Now, clearly, there will be issue of talent. You will get a lot of talent at the bottom because you are better paying than the market. But how will you retain them at the top? Because outside market is paying far more. So PSU banks, in order to revive over a period of time, will require not only capital, but also change in compensation policy, and also giving them administrative flexibility so that they can do their business more openly, more freely.
Nilesh, always a pleasure having you on the show. Thank you so much for taking the time out and speaking with us.